get into the week. Let's get into the weekend and what has transpired. Thank you to all those who are viewing us on Facebook. I think we finally just crossed over onto our social media audience, and let's get down to the data of the day. Now, on the FX markets, Vernon, we did see that the Kwacha has continued its perpetual slide. This is seriously getting concerning. 75 days of the Kwacha losing value or the dollar raising in value. This is, as I said, the second longest streak in the history, or at least on record, when it comes to FX losses. We are seeing the Kwacha still at about 18 point, the US dollar, sorry, about 18.5848, which was up 0.24%. From the previous day, and we're seeing a little bit of the momentum picking back up again. The dollar is still overbought and still in a hold trajectory, so we are still waiting to see how this plays out. Now, against the rand, we're still seeing this crooked movement, not so straight as the dollar would be, but we're still seeing it moving upwards in that trajectory going forward. So we are seeing that the rand versus the kwacha is up 1.5% year to date. Versus the dollar, which is up 2.7% year to date. So there has been a little bit of resistance on the rand, which is in a buying pattern, but it's starting to go in a selling direction. So buying momentum is picking up, is still in the rand, but it's still moving in a selling direction. That's the major news coming from the FX market. Now, going into the bond market over the weekend, I just want to quickly share some data from the bond auction yesterday. Now on Friday, we did see the bond auction coming in, showing that interest rates on the 10-year actually went up, even though we had a strongly oversubscribed bond auction as of Friday. And what we're able to see now is that we saw a fully subscribed 100% bond auction, which saw 926 million kwacha raised from the 10-year bond. But unfortunately, that was mainly driven, and I'll just show you this quickly, that was mainly driven by the fact that they were 1.2 billion kwacha worth of 10-year bond maturities. In other words, the 10-year bond investors from a while back got their money paid back to them and seemed to just reinvest the money. So it wasn't fresh money and new confidence coming into the market. It was a sign of what we call maturities. And as we can see, also, we're seeing 2-year maturities, which came down a little bit. So you saw a lot of performance from the 2-year, the 3-year, and the 10-year. That's where the majority of the bond auction came in. And you can see in terms of our composition, in terms of our sales performance, again, it was a startling performance from the 2-year bond, 222% above target, with 147% of sales on the 3-year bond. And it was the 10-year bond that was 165, which was a surprise, mainly driven. So what you're seeing, Vernon, is the fresh money is going into the 2-3-year bond, while the renewed money, and we're seeing this a lot, whenever there's big maturities in the market, the 10-year bond performs very well, and it gives us the image that we saw a highly subscribed auction. And as we can see, that's what pushed interest rate up. It's something we call bond aging, because the average, the auction, the composite tenor, in other words, the average duration that somebody was going for investing in the auction, shows that the bond age moved from 4.6%. Sorry, that's a bit hidden, to about 4.16 years to about 6.16 years. So simply put, looking at this data, and I just take that down. Simply put, looking at this data, what we're seeing is that the auction performance, that oversubscribed auction, which hits a lot of headlines, people say it was oversubscribed, is just a situation of it was just a situation of rollovers of 10-year bonds that came due, 1.2 billion kwacha worth of 10-year bonds that came due, and people just reinvested them back. So that's not going to reflect in another one until we start seeing 10-year investments outside of rollovers. We're not seeing this as a confidence sign, because some have signaled it that maybe it was a confidence sign of the fact that we're getting 2 big visits coming into the market. And in fact, we've got one of them here. So over the weekend, we also got news, speaking on the bond market, that Janet Yellen...
Sorry for cutting you short. I'll be just in a bit, as I will just have a look at 60 pretty much.
Yeah, no, we will be back after 60 at 60, yeah.
strong institutions and generate
joining Mutwale, online. So remember that the frequency is not 3.7 FM. Hi, Mutwale. We can pretty much continue the conversation from where we ended at.
Thank you very much. So we are seeing the IMF and World Bank visits coming into Zambia, and we're going to quickly play the message from the IMF chief, Kristalina Georgieva, who's actually arrived in Zambia as of yesterday and shared her message. So quickly, let me add this in.
From Zambia, a country that is striving to build strong institutions and generate growth and jobs for its people. It has so much going for it. It has beautiful nature, rich soils, fantastic reserves of minerals that the world needs for economic development. And it has wonderful people. I'm in Lusaka National Park, and what impresses me so much is the care for nature the Zambian people express. This is a place where they take care of baby elephants, but with the same care, they cover 30% of the territory of the country, national parks, to protect the richness of Zambia. For us at the fund, there are three priorities. One, work with these government now striving to resolve the issue of debt. Two, work on what our program can do to support institutions, because we know the strength of institutions defines the strength of a country. Three, discuss with the president how we can join forces to think through the sources of economic growth for Zambia for the future. I'm very impressed by what I have seen so far, a city that is clean, green, and vibrant. And I hope that our work with Zambia would make this country, 90 million people, more prosperous. With my thanks to everybody who I have met so far, Salani Bueno.
Right. You'd almost think that was a sales pitch of our country. That was really well put together. Now, if you no, as in, it really seems like a sales pitch, and the question is to who? You can see that I'll tell you one thing that is evident here. It is evident that the IMF and the World Bank and the U.S. Treasury are all in when it comes to Zambia getting a proper deal here. They're all in on Zambia, and the reason is this: the G20 common framework with this finally gives the Western world back its relevance in the developing world. Because what was happening over the last 20 years, or at least the last 10 years, in fact, from that time, President Manasseh gave the accelerated development speech back in 2007 in America, where he blamed the American and the Western world for shunning Zambia and giving them too many harsh conditions. And he said that is why China has become a strong part of the economy. And in terms of investing, 2007, President Manasseh made a simple statement stating that China had gone from 0 development projects to 37 development projects in just a matter of years during his administration, and the Western world was getting concerned. Now, this has been happening across Africa with $170 billion worth of Chinese debt in the poorer parts of the economy. And from what you are seeing, the rest of these nations have been losing their relevance. Vernon, in the last statistics, I think that came out back in 2021, it was found that 66% of all debt owed to the top 20 economies in the world was owed to China. Okay, from poor nations owed to the top 20, 66% of it was owed to China. And that was a very big concern for the Western world, who actually get their minerals from countries like us, seeing that China has such dominance in the debt profile of Africa and of developing countries. So you can see this common framework now becomes a way for the Western world to get its influence back in the developing world. So they are all bought in this situation when it comes to it. So that's why you're seeing such strong support. And that's why the likelihood, I think that the issue that is kind of circling around our debt, and this all boils down on our debt. Because what people don't understand is those interest rates you're seeing on bonds are a combination of the what's it called? The LIBOR rate, the London Interbank Lending Rate, which forms the floor of interest rates. Okay. So those are the baseline. And then added to that is what we call the country default premium. In other words, what is the risk profile of our country? And what we see is that LIBOR is sitting somewhere about 5.6%, and our country default premium is 20.71%. So about 80% of that interest rate that you're seeing on the government bond is actually coming from the risk position of this country. And that risk position only gets unbundled when we reorganize our debt, which is what the IMF, the Treasury Secretary, all these negotiations are based on doing. So that is the tension that this is bringing in. But the issue at hand actually comes from the second story about it. Janet Yellen, the Secretary of Treasury, who's on her way here, while in Dakar, in Senegal, said this. U.S. Treasury Janet Yellen again expressed cautious optimism that China will be willing to enter a multilateral debt restructuring with Zambia. The potential agreement is seen to be crucial test for the efforts to help bring developing countries finding more relief under crushing debt. And remember that Zambia is a test case. Her statement actually was, our counterparts are sophisticated economic officials who can listen to a reasoned argument and understand it. Yellen told reporters in Dakar on Saturday, and says, I definitely think that they get what the problem is, and that there is need for a solution. So she is highly likely thinking that in Zambia we will be. Remember that we are the canary in the coal mine. Countries like Sri Lanka, Pakistan, all these other countries that were on China's Belt and Road lending schemes are all looking to what is happening in Zambia with expectations of what they're supposed to see in their debt. So this is why this is ground zero. This is the battleground for the influence of the world. Remember that you're getting what we call a regional split, the Chimerica rift, as I like to call it. And that's reflected in the fact that China and America are starting to drift away, even though they used to be global supply chains, and they're getting into competition. So this Chimerica rift is now starting to reflect. Zambia is the perfect split of Euro bonds and Chinese debt, where about 50% of our debt is profiled with China and the rest is profiled to the Western world. So this perfect split actually creates the perfect geopolitical battle zone for the global debt markets, and especially for the developing world. So that is why that's why you are seeing two of the most powerful women in the world coming to visit Zambia at the same time. So they're signaling to the rest of their investor community, the IMF and the US government are behind this country. Get behind it and support them in a debt restructuring. So here are the two factors that are kind of playing this out. One is that China has been complaining that the reason why China has been stalling with some of these talks is they're saying, why do these multilateral lending institutions such as the IMF, the World Bank, these ones, why are they not also taking a haircut on their debt? Why is it just China and the Euro bond holders? And they're getting frustrated with this. Okay, so that's the concern that they've been having. While simultaneously, your Euro bond holders are having two problems here. One, they're still seeing that Zambia is in default with the 2022 Euro bond. And two, they're in situations where their own central banks are coming with harsh interest rates, aggressive interest rate hikes. I'm going to read you a statement that was issued by Christine Lagarde, who is the European Central Bank chair. And she said, Christine Lagarde warned on Thursday that inflation figures remain way too high and reiterated that the ECB's plan to bring inflation into the Eurozone back down to 2% target through aggressive monetary policy decisions. You got to think about what that means. She's saying, I'm not putting off the gas on interest rates. Okay, so if the central banks are signaling that they're not putting off the gas on interest rates, that makes it very difficult for offshore bond investors to consider still coming back into Zambia until their central banks bring easy money back. Because what brings money into Zambia, allows investment into Zambia, is that central banks are pumping in so much cash into the global economy, into their financial systems, that their asset managers are now then pushing that money into the developing world through bonds and trading of securities. Another piece of news said in the U.S. Federal Reserve Governor Lael Brainard added her name to the long list of Federal Reserve officials who have voiced their opinion that rates will need to stay elevated until a further period of cooling inflation. So you can see that the central banks are still aggressive here. They're not playing around. And the central bank aggression is going to lead to a lot of a stifling of people being able to reorganize our debt, agree. So here's the thing, Vernon, when it comes down to the debt renegotiation, it was easier when President Chilema walked in. It was. Interest rates were sitting at 1%. Central banks were still keeping interest rates low. So for an offshore investor, reorganizing Zambia's debt still looked attractive. Now they've got 4% bonds, 5% bonds sitting in their country, 5% LIBOR rates. It doesn't make sense. And then Zambia, on top of that, has defaulted on its 2022 bonds. Okay? So we are in default on a bond, plus they're dealing with 5% interest rates. These are dire, different circumstances than we were seeing in August 2021 when interest rates were 1% in America and we were not in default. Therefore, our credit default, our country risk premium was 9%. So if you think about it this way, I want you to think about it. For an American investor, what was attractive was 10% return on investment, which you can get from a 364-day treasury bill when President Chilema walked in. Today, the American investor wants 25%, 26% return on investment. That is drastically different, okay, from where we were at the beginning. And that is the negotiation position that has changed dramatically. That changes the calculus. So the assumption is that the moment China says, cool, we're just going to say the Eurobond investor is going to say we've got it in the bag. But they're saying, hold on. Our calculations are different from where they were when this conversation started. So you can't assume the same dynamics. So there is a big issue that they're facing right now because they've lost a lot of money on the stock market. They've lost a lot of money in their bond portfolios. I don't think they have the stomach for loss that we are assuming that they'll be able to take. I don't think they have that stomach to take losses again. That's where the problem is coming with the offshore investors that we're not paying attention to. But the strong signals are that from the bilateral perspective, we're probably going to get a lot of agreements. And that's what these main two conversations are about. And that's some of the news that we're seeing. And a lot of it is playing out in our bond markets. That's what our bond markets are basically explaining to us. And that's the information that we're getting from the situation. So I will say this to the local person who's trying to put up their portfolio, because the question I think everyone is asking, okay, so what should I do with my money? What you should do with your money in a situation like this is that fixed income, in other words, bonds, deposits, fixed income and high yield debt are still got elevated interest rates in Zambia until this sticky situation about credit is come down. So there is what we call a lovely real interest that is for Zambian investors. There's a good real interest rate that is sitting there for Zambian investors, which is quite healthy. So this is the time I keep saying that your options are, this is where you pile in and you actually grab as much of it as possible before the debt gets resolved. Now, this debt looks a bit sticky to me. It doesn't look as easy as we think. I think, yes, we can get China and America to actually agree because China is in issues here and they also need to have some of this debt reprofiled so that they can get repayments back down the line. But I'm not sure about your Eurobond holders. Some of these guys are not happy about the situation at hand. And you can see it in countries like Ghana. You can see it in countries like Kenya, especially West African countries. You can see it in what's happening there, and also Central Western Asian countries. you can see these guys are not as easy to push over as we thought, like they were maybe 2-3 years ago when we started our IMF conversation. So that is just something I wanted to put down for as many people to pay attention to. Now, finally, as we get into, before we get into today's conversation, remember that we are still going through the financial matrix. Before we get back to regular Mindset Mondays and everything, we are getting through the financial matrix. Let's take a look quickly at how the secondary market for bonds is also doing. Our secondary market for bonds is up 1.25% year to date. So before we get our inflation figures, we are expecting probably 1% above inflation this month. Usually this month we get about 1-2% above inflation. I'm saying monthly inflation. So we are expecting at least 1-2% monthly inflation somewhere this month, because this is what we call the inflation hill. So the November, December, January, February are what's called the inflation hill. So whether these returns will be good enough, that's another story. The offshore bondholders are having a nightmare because of the FX rate. So bonds traded on the secondary market year to date, or marked to market, what we call marked to market bonds, they are down 1.48% on the year. It's the held to maturity ones that are doing quite well. And then finally, we're also taking a look at the GRZ bond yields, which are still at 23.63%. Interest rates have still been coming down progressively over the last period. We are still continuing to see 3 consecutive days of interest rates on secondary market coming down. So in as much as things are going well on the secondary market, it's still the hold to maturity. Those who buy government bonds and wait for them to mature and get paid back and reinvest them, those hold to maturity investors are looking. So when you're looking at your fixed income unit trust that's sitting in your portfolio, we're still seeing a much better slant towards those who are investing, towards those who are rolling over their instruments, those who are investing, holding to maturity and rolling over instruments, and they're not, say, trading on the secondary market and they're not marking to market. So look at your unit trust, whichever one does bonds, which of the ones are the conservative ones that are doing hold to maturity. As of last year, going into this year, they are performing better because the mark-to-market ones are not doing as well, and the secondary market is signaling that. So that, Vernon, is the situation when it comes to our bond market. Now, taking a look finally at our commodities market, in general, our copper prices did close last week up 0.38% in 0.83% on Friday, and up 2.59% for the week, up 11.57% year to date. So copper has really had a strong rally, and that's because the dollar is getting weaker on hopes that the central bank will reduce interest rates, but there is resistance from some of these central bank chiefs. They are not tolerating that conversation. However, in the news in the copper world is that in Caruso region, the gateway to Machu Picchu, where there is the Glencore major, I want to get this correct, Antapaccay mine, copper mine, was suspended mainly due to protests that are happening in Lima and protests that are continuing to happen over the second. We've really seen vicious protests in Peru, the world's second largest copper producer. So this is affecting supply. All these strikes are affecting the supply of copper happening as well. Other thing that we're seeing is the world's largest copper importer, being China, is expected to see a strong economic boost from the week-long Lunar New Year holiday. So we are expecting that copper prices now have got some upwards momentum. What are we seeing them on? We're seeing copper prices on 9,341. This is the highest we have seen them in a long time, Vernon. 9,341. That is the highest we have seen copper prices in an absolutely long time. In fact, if we go back to some of the reads that we were seeing earlier in the year, we'd have to go back to the beginning of 2022, before the Russia-Ukraine war, or sorry, just before the Russia-Ukraine war, to go back. I think, in the middle of the Russia-Ukraine war. We saw this in June 9th. June 9th and June 10th was the last time we actually saw rates this high for copper. So we actually are getting back to some strong copper rallies that are happening. Now, also in the oil market, what is concerning is that we're starting to see signals that we probably will see an oil price increase at the pump of potentially 55 ngwe, mainly because oil prices are actually coming up. And as we're seeing on the market, oil drifts higher. That is the news that we're seeing. Oil drifts higher as it weighs Chinese Lunar New Year and economic data. However, The Paris-based International Energy Agency said on Wednesday that global demand for oil could reach all-time highs in 2023 as China rolls back the lockdowns and restrictions that it had from COVID. And there's also growing forecast that the economic resurgence China will help oil bulls coast through another week. So we're seeing the Chinese reopening is pushing oil prices up alongside our FX losses, which are going to continue probably till middle of February. It's probably going to take until middle of February when the momentum finally shifts and we can stop that. So right now, one of the best performing assets is gold, and it says gold prices rose higher on Monday. As trading closed at 9-month high, as markets await more U.S. economic data, GDP data for the fourth quarter in America is coming out this week on Thursday, and there is a potential recession. So some of the other news that we're seeing in the global economy, as we pointed out, we have seen central bank chiefs pushing an agenda. Here's some international growth data. The National Business Association of America, the National Association of Business Economics, says that only 53% of economists think that it is likely that America will go into a recession. This is down from the October poll, which said 64% of economists. So we can see that there is less likelihood of a recession, or there's more optimism hitting the markets. The likelihood has basically come down again. Now, there are still signals. Okay. Now here it points out approximately 53%. So it's not 56. It's 53% of those polled on the National Association of Business Economics said that they had more than even expectations that the United States would enter a recession over the next 12 months, while 3% indicated that the country was already in one. And this is down from the poll in October, which said 64%. While in Davos, Switzerland, this is a statement that comes out. The year ahead looks better than feared, but the global economy still seems fraught with risks on the escalating conflicts in Ukraine and the emergence of transatlantic trade wars, in other words, America and China. So it's not as bad as we thought, but it's still a tough circumstance. So what are my four horsemen telling me? My four horsemen are telling me interest rates are likely to remain sticky. Though inflation is coming down, we're seeing trade data expected to pick up. International trade is expected to pick up, but growth is still fragile, but less fragile than thought. So cautious optimism is what the four horsemen are telling us are the winds, the economic winds that are blowing in. So we're slowly getting a global growth scenario that might play in. But remember, China is a touch and go situation. That, Vernon, is the roundup of the news. That we were seeing from the week. We were seeing from the weekend. So to everyone that's there, we'll see if there are any questions that will probably arise. Now, before we get started, Vernon, in our next conversation on the what we call the financial matrix, we completed last week going into the financial planning matrix. We're going to be moving into what I call the wealth matrix. The investing and wealth matrix. And I call this investing by age. So if you're with us today, again, remember, this is a write things down moment because we are prepping you for the year and we'd like to see you prepare yourself for investing. So today we're opening up. So we want to see that writing emoji in the comment section if you're with us, and also signal to us what you'd be looking for. So we're looking at what we call the investing planning matrix, which asks a few questions, Vernon. What should your investment theme be? Where should you be? What is your advised time investment? Where should you be investing your time? Where should you be investing your money? What investments should you avoid? And what investment pitfalls should you avoid? These are questions that the people are going to go through. And I'm going to go through them through each of the decades of life, 20, 30s, 40s, okay? And then your 50s as well. So these are the various decades of life that we are going to be talking about that should actually get you going. Now, before we get to that, Vernon, I wanted to just put a quick verse in our minds It is Mindset Monday. I just wanted to put something in our minds that we can think about before we get down to that conversation. There's a proverb I remember I was sharing with a friend over the weekend, which caught my mind, and it says this: it says, "The diligent shall rule, and the slothful shall become slave." I always look at this as one of the greatest economic principles, and if you want to see me break this down, you'll see it on the Next God's Economy, or one of the Next God's Economies, where I want people to actually understand that productive people who make money will always rule. This is a statement by King Solomon, who was reflecting God's wisdom. This is Proverbs 12:24. And it basically says that those who are lazy are always going to overconsume, while those who are productive are always going to produce less than they consume. Okay. And that means that if I'm productive, and I want you to think about this, Vernon, it's a very simple way of thinking about it. Entrepreneurs, let's look at our bosses here. Entrepreneurs in any business are so hardworking that they've run out of hours. And what do? They buy the hours of people who have money, who have time to spare. Okay. So people like us, we are here because we have an hour to spare. We haven't used up our time because we're not as diligent, and we have an hour to spare. That's just a little bit of a sledging. But the reality is that an entrepreneur is a diligent person who buys the time of people who are less diligent with their time and with their lives, and therefore they rule. So there is the answer to that question right there. That the diligent will rule. Those who produce so much that they run out of time, that they have to go around buying other people's time, they will rule. While the slothful who have excess time will always be ruled. That is something that you must always remember. So in life, if you want to have a power position, be productive. Be so productive and so innovative that you are able to start buying other people's time. You know what that's called, Vernon? Investing. That's what that's called. It's called investing. Investing in your business, investing in your assets. Yeah. When I buy a share in a company, I'm buying the time of their managers, I'm buying the time of their employees, I'm buying the time of everyone because I get compensated for it. Right. I don't know what your thoughts on that are, Vernon, before we move on to the investing matrix. Okay.
We actually have a few friends of ours who actually have joined us this morning. This is Wixa Mulumbwa Jr., who says good morning, and we have Blackchin Joe who say good morning, Munyumba and Vernon. Happy Monday. I'm tuned in and ready to take note. Of course, it's exciting to know that we have some of ours who actually are joining us online. And pretty much for even more, of our friends and colleagues who would like to just be following the conversation online. Pretty interesting, progress, and glad to know that some of our friends are with us this morning.
Okay, so yes, and welcome to everybody. As I said, no taking time. We are getting into the investment matrix now. The investment matrix asks the question: what should you be investing in? Okay, and that is the key question everyone is knowing. So we went through the financial planning matrix, which looks at making money, managing risk. We talked about debt. We talked about various things. Now, this time we're asking the question. So let's start with a person in their 20s. Okay, in your 20s, what is your theme? Well, in your 20s, you should be, by the end of your 20s, you should be looking at being somewhere between 120 to 360,000 kwacha in assets. If you started well, most people don't start in their 20s because maybe they finished college in their early 20s, they've started work, and because they've started work, maybe they've taken on too much responsibility, trying to live on their own too early, those kind of things. And I know it's shunned. People say, no, but you're supposed to go and get started in life. That is not easy. Today's world, we're looking at a higher cost of living because 55% of jobs are found in 2 provinces in this country. 55% of jobs are found in 2 provinces in this country. That already tells you that we've got a serious problem with the demand for property and housing just in those areas alone. And a lot of people will find themselves in excessive financial strain trying to live on their own straight away. So there is an advice to young people to try and take it as slow as possible. I know there's this hunt for freedom to try and break free and be what you want. but you are putting yourself under excessive levels of financial strain. It's not as easy. I would advise as many young people, and I know this doesn't sound like a popular view, I would advise people to say, you know what, hold off on the decision to run out. Don't become a lazy sloth and say they're going to take care of me continuously. Go and get work, but maybe, as I always say, people rent your room. Okay, start by, before you rent a house, maybe rent your parents' room and say, look, can we have an agreement here where I can have my room and I can pay for it? If that is the case for you, because get started in that way and try and see if you can try and work your way out slowly, acquire things slowly, and take your time in these things. It's not a rush that people are trying to get to. It's not as easy. Some of you are coming out of school with student debt. That even makes it worse. So this is why I'm saying you have to try and take it as slow as you can and start building your asset base and building your life. So 20 to 29, your expected portfolio when you're coming out of that should be 120,000 to about 360,000. That puts you en route to be getting towards the 1 million to 3 million kwacha by retirement. So we're talking about trying to be financially independent by retirement, at least financially secure to financially independent. Somewhere there is where you want to be when you now get towards retirement, so that you don't starve and go into pure destitution, but you can try and have a decent and dignified retirement. Now, when you're investing in your 20s, here's what you need to understand. You have a 58 times multiple on your money. So when you invest a kwacha, okay, in your 20s, what you should recognize is you have a lot of power during that time, a lot of power in your money, meaning that money invested in your 20s, on average, given the rates of return that we have seen, with an expected rate of return of inflation plus 6 to 8%, should be able to give you what's called a 58 times multiplier by the time you get to 65, if you retire at 65. Money invested at age 20, on average, remember people, markets do not give you, okay? Markets do not give you a guaranteed return. I'm just telling you what the data has shown, okay? There's no guarantees here. It is an average based on data. On average, you should see that that money invested, a kwacha invested in your 20s, at age 20, can go on to become 102 kwacha, adjusted for inflation, after inflation adjustments, by the time you hit 65, if you invested in the mixed portfolio of stocks and bonds. So if you think about it that way, where you're more aggressive when you're young and you're less aggressive when you're older. So every million you want to retire, say you want to say, I want to retire with 5 million kwacha by the time I hit 65. I want to have 5 million kwacha in today's terms, or that lifestyle, having 5 million kwacha in assets. Well, you need to be investing 231 kwacha per month to try and target getting there. So for every million you want to invest, you need to invest 231 kwacha at least. So if you want 5 million kwacha in that time, are you investing 1,000 kwacha every month in your 20s? Okay. So remember, I have a saying, Vernon, in my firm, we say tomorrow begins today. So if you want that tomorrow, what are we doing today? And that's these are the statistics that we kind of advise when we're trying to break down what is the advised savings rate for people. So start investing no matter how small. So that's the beauty of investing in your 20s. 231 kwacha invested every single month into the market, split between stocks and bonds, especially, is able to get you to, it has the ability, okay? Now, it is not definite, but it has the ability to potentially get you to 1 million kwacha in assets if you continue to invest all the way towards 65. So that's the target. So aspire to 20 to 25%, but savings rate, but start at, and here's what I advise people, your age minus 20, okay, and increase annually by 1%. So this is just a place to start. Start with your age minus 20, okay? If you're like 25, maybe start by saving 5%. Start there, okay? And then say every year I'm going to increase that percentage by 1% until I get there. And then in your 30s, start to ramp it up by 2%. So that's what I want. I want as many of the people in their 20s, Vernon, just like you, to start doing. So focus on wealth creation. No matter how small your salary is, you are actually creating wealth. especially if you keep investing it. There are unit trusts that allow you with 200 kwacha to take it in. There are options to get into the bond market as low as 250 to 500 kwacha a month. There are ways. What you need to start doing, and this is where I'm going to talk about your time allocations. If you are 20 to 29, you need to start investing in your proficiency. Okay? Get your 10,000 hours and constant study of mastering your field. Become very good. Use age 20 to 29 to not look. I know it's almost liberating. 20 to 29 is liberating. We were there. We made the mess ups. But to the next generation, this is the time to become proficient. You have the time to go and start touring the world and seeing these things and having the time of your life when you get older. Trust me, if you make the good decisions now, you'll have a lot more freedom going forward as opposed to sacrificing your freedom now and having it. So use this period to get your 10,000 hours of experience. Volunteer where you can. Get the extra time, but punch in the hours where you can. Okay? Master your skill. Whatever your skill is. Remember I said, at this point, you have to learn how to make money. Your 20s, you have to become excellent in making money. Okay? How you make money, it's time to get good at that. And remember, you make money by solving, serving, or selling. That's what you do. You make money. So what is it that you can solve? What problem can you solve? What solution can you sell? What people can you serve? Bigger, better, faster, stronger, simpler, cheaper than anybody else. Okay? And focus, dead focus on that. So at this point, maybe get a career mentor. Your time investment should be to get a mentor. Who is mentoring you in your field? This is what getting a job is for, by the way, people. When you're young, getting a job is also good because the person who's your boss, your supervisor, is actually your mentor. Okay, that's the easiest person to become your mentor. And to young people who are looking for a mentor, here's the reality. Asking someone, can you please mentor me? It seems like a nice and bold and smart thing. But the reality is that even the person, even if they say yes, they're not going to have time for you because you're of no value to them. So the question is, if you want to be mentored by somebody, the question you need to ask is, what can I do for that person? If you can do something of value for a person who you want to be mentored by, that person will take time to work with you. That person will take time to groom you and work with you and do what they can. So start by volunteering. Start by doing what you can. Your 20s are the time to stick your hand out and try. Invest in personal development and credentials. This is the time to get certificates, practicing certificates in your field. So what are the practicing certificates of your field? This is the time to get certified. If you're in finance like me, this is the time to get certificates in corporate finance, certificates in this. Rack up certificates because those professional certificates are really what get you paid. Your degree is cool, but trust me, your professional certificates are actually more valuable to your employer than even your degree. So really start working on that. Put some guardrails on social media usage. There's an app I've had to install for myself called Waste No Time that I've put on my Google browser, and I've put another app on my phone called Block, which actually I've actually put it that I can't uninstall it. I've actually programmed this thing that I can't uninstall it, so it actually affects my social media usage. And that is actually, those are important applications to have. So look for applications that can put some guardrails on your social media time, restricting it to after hours, things like that. Those are important things that you need to start looking at. Experiment with your career when you can. Okay. Where can you try new things in your field so that you can master? Booker T. Washington gave us the 9 steps to mastery. And we've covered this multiple times, and I'll share it on my page again for people. But there are 9 levels to mastery, and he kept on saying, get good at one part of the component, try experimenting various parts of your field, do other things. And really at this point, if you're talking about social investment, because you do need friends, you're not meant to be alone, you're not meant to be an island, you need to partially enjoy your life. Make sure you create inexpensive memories. Debt-free, don't go into debt making memories, okay? Borrowing for going to events, borrowing for trying to go on holiday, borrowing for going out on the weekend. Avoid these things like the plague, people. Like the plague. Avoid them, okay? Now, where should you be putting your money in your 20s in terms of investing? So we've talked about investing your time. We've talked about the power of your investments. Even your time investments also have got very strong, compounding power. Because the things you practice in your 20s are the things you become very excellent in your 30s, and the things you get paid very well for in your 30s. Okay, so once you become excellent at something and specialized in something, Dumisani Ngube said something. He said in an interview, I think it was on that Z podcast, he said, niches bring, so he says,
Yes.
riches are found in niches. Okay, riches are found in niches. And what he's trying to say is, when you have specialized, is when people come to you. I've specialized in bonds and fixed income and retirement planning. People come to me directly. Okay, they seek me out now because I've specialized in an area. You can become a jack of all trades and be available to people, but you're going to have to do a lot of selling. But when you are very good and you've reached the top of an area, okay, you've become world class at something, those who need you will seek you and they will pay a premium for you. That's where the messages will come in. Can you make this? If you're a cake maker, if you're a plumber, those who need you will seek you when you're at the top of your field. So really, the investments you make in your time are very good there. What you should be investing in your 20s in terms of your money is find as much free money investment accounts. What I simply mean is where there's no costs. Okay, try and get as much minimal cost structure, but also wherever there's an employer match. Free money investment accounts is things like your NAPSA account. When you put money, your employer already doubles your money at the beginning. That's what we call free money investment accounts. So your employer match pension accounts, your NAPSA accounts. Look for whatever tax-free that you can try and get, and start using simplified target age retirement. When do I want to retire? How much do I need to be saving? What do I need to be putting in? Simplify your investment plan to one page. And in your 20s, my advice to everyone in their 20s, use basic bonds and unit trusts. Bonds and unit trusts are your friend in your 20s because these are simple assets, very, very, very simple assets with very low risk, and you can build up the habit of saving and investing. And very quickly, Vernon, I'll just try and run through this. Investments to avoid holding too much cash. Young people hold a lot of cash. That's where a problem comes in. Avoid holding too much cash because you fear the market. Cash gets eaten by inflation a lot. Okay, it's the worst performing asset because it gets eaten by inflation. Avoid trendy investments. Stop trying to be too smart and trying to be too hype. Oh, I'm in with the new thing. I'm in with the hype. Invest according to principles or not trends. Avoid as much self-management. Try and do as many unit trusts as I said, because you're not experienced yet and you're trying to gather experience. Avoid trying to become an overnight guru and getting lucky. What you want to do is take your time. Investing takes time, people. So you want to become good at an asset class very quickly. And finally, avoid investing. And these are the things you want to try and also avoid in terms of investing pitfalls. Rejecting the advantage of an employer match savings scheme. So if your employer is matching your investments, things like your NAPSA account, things like your workplace pension, if you're able to get one, or your gratuity scheme where your employer is doing the work, trust me on this one. If you are getting a gratuity at work, if you're able to even negotiate that, that's very good for you because the gratuities are tax-free. That is a tax-free investment vehicle. It's to the employer, it's tax exempt. To you, it's tax-free. It's a wonderful deal. Don't try and outsmart yourself. Just stick to basic asset allocations. And saving right now is much more important. The amount of money you're putting in, so the savings rate plus the duration you want to go for, is far more important than the rate of return of the investment. It's how much money you're saving and how long you want to be saving in your 20s. That are the main things. So that is the profile of a 20 to 29-year-old and what they should be looking for in terms of their investments. So we'll be going through 30 to 39 tomorrow. We'll be going to 40 to 49 on Wednesday, and we'll be going to 50 upwards on Thursday as we look at the investment planning matrix, where we answer the question, what is your investment theme? Where should you be investing your time? Where should you be putting your money? What kind of investments should you avoid? And what are the pitfalls you might want to not fall victim to? So to everyone, if you enjoyed this, please give us a comment, share it with some friends, maybe tag some friends if you think that this was useful and was helpful to them. I think we've lost Vernon for the meantime, who has had to dash off to do other things. But thank you to everyone who's joined us, and have a wonderful and blessed day. Have a wonderful and blessed week. Keep your mind on the prize. Remember to be diligent in everything you do, as that is the path to ruling. So everyone, have a wonderful day. God bless.